Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStock, CSW, nor its affiliates, nor any of the respective officers. Personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involve risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. CSW provides education and training services that are meant to teach you to the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on a specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any loss you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone.
All right, fantastic. I've been behind all day. All day long, something has been happening to put me more and more behind. It's crazy. All right, so apologies about being late, and how are we doing? Let's see. All right. Let's see how the market's doing, indexes and all that. Ooh, it's coming back down again. That was not good. That's a weak bounce. All right. We'll take a look at that in a minute. Let's talk about some charting on the 5% rule and see what we see. Oil is not doing much, considering that the report was a release, but that's not surprising because we think there's a lot of overhang pressure on these contracts, so we're going to watch that closely. We have a long-term SCO bet. We have the spread on the contract futures, but that's a long-term play also. So nothing too exciting here. Ooh, look at gold. Gold hit 1290 and fell all the way back to 1277. So it's a 1% drop, like really fast on gold. Silver 2 topped out at 1720, back to 617. I do like playing at 17. I like playing at 17, but really 1690 is really the key place where you want, where you can have a little bit more confidence getting in. Not much confidence at 17 that it's going to hold. That is for sure. Coffee came back to our buying spot yesterday. We already made that play and made some money on it. Nothing particularly here, so let's just talk about the bounce lines and what we expect out of these indexes more so than anything else. So I want to talk about that, and we'll talk about some of our trade ideas and some new stuff. As to comments, all right, let's see. I'll tell you, see if I can quickly summarize what I was talking about in chat, although not everybody who's was asking questions is necessarily here. Priceline, I told Albo, Albo, I don't know if you're here. I said what I replied to him was that I like Expedia better, and Expedia is in a pretty good spot. He's talking about Priceline. Let's take a look. PCLN. I always found Priceline, it always scares me. It's a very expensive stock. It's tough to play, and it swings so violently. I mean, and violently, I mean, if you're wrong on a Priceline option, you can get screwed by hundreds of dollars. It is not something I would generally want to play. Expedia, on the other hand, I find is a great value play in the same space. Oops. And they're also on sale. They're back at 120, which is not as bad as 1600 or whatever the hell Priceline is. I'm not saying buy them here. In fact, what I said to Alba, I said if they come down to 100, that's when I start really getting interested in these guys. So if you look up, where's Yahoo? So if you look up Expedia, EX. Now, we picked Expedia a couple of years ago when they were super cheap. They're not cheap now. The PE is like 56. That's why I'm not that interested now until the PE gets down to like 40. But the reality is, for $18 billion, they're capable of making a lot more. They just have had some restructuring issues and things going on. that caused an impact back here, but they're back on the path now to make $1 billion. So the PE on Expedia is very misleading, I think. And I think down the road they should make quite a bit more money. What do the analysts think? Let's see. The analysts say they're going to make $5 a share. All right, that's still a high PE. You're still looking at a PE. $5 a share is 20-something. All right, but it's not the 50 that it shows at. That's what I'm saying about Expedia. So I think there's a little more bang for the buck going forward on that. Priceline makes $80 a share, so their PE is like 20 anyway. So that's not bad. I mean, if they make 75 now, but whatever. Point is, they're also in the 20s, so they're getting into a reasonable price. But to me, it's just a scarier stock to trade. I'm a little more comfortable trading a 120 stock than a $1,700 stock if both are relatively the same value. And obviously, if Priceline is this big, then Expedia's got a lot more room to grow. That's another thing I like about it, right? It's like, bro, Priceline found the magic formula to take over that part of the market. Expedia's got a good base, and if they get the contract here and the win there and get into this country here, they might start doing a little better too. A little more room to expand. All right, so that was one comment. Tahi asked about Square, and I don't know if Tahi's here, but on Square I was saying, and again, look, something's easy to check out. Like, look, if you're looking at Square, $15 billion company, right? And they don't make any money. That's beside the point, though. But let's assume they could make money. $15 billion market cap, $1.7 billion in revenues, right? Now, all we got to do then is look for a comparison at MasterCard. They have $10 billion in revenues. They have like 10 times the revenues. They have profit, but let's forget the profit. They have 10 times the revenues, but their market cap is, not 10, I'm sorry. Let me try that again. Their market cap is 157, so it's 10 times. Their revenues are 10 billion versus Square is 1.7 billion. So even if Square gets much higher, they're already priced as if they're already in that space in MasterCard. The chance of them actually growing, taking market share, and doing this and that, they're not demonstrating a superior ability to make money. That's the problem. There's no evidence here that they should be priced at double what MasterCard is being priced at per dollar of revenue. It doesn't make any sense. Oh wait, where to go? So if MasterCard is dropping $10 billion in revenues and making a 40% profit, even if you assume that Square is going to do that, and they'll get profit because all their revenue is just fees for credit cards. But even if you look at Square and say, okay, let's say they double their revenue to $4 billion and they make 40% to the bottom line, it's $1.6 billion. That's when they, there they do justify it. So if they double their revenue and pick up the internals and so on and so forth, but, you're already pricing them as if they're going to do that. And they're nowhere close to it. They're years away from making that. So the fact, just because they got cheaper than ridiculous doesn't mean that they're not still ridiculous. Now, why do people want to buy Square, though? Because here's the thing, though. If you assume that Square eventually can become competitive in the space. So let's look at Discovery. What? DFS, right? So DFS. So here's Discovery. They're $23 billion market cap. They have $10 billion in revenue, 10 times what Square has. They're dropping 20%, 23% to the bottom line. Not quite as good as MasterCard, but not bad. So they're dropping, and of course the reason is because when you only have the $10 billion in revenues, you're not swallowing your SG&A costs, your sales and acquisitions and and administration costs. Okay, so in other words, MasterCard, they all have to do the same thing. They all have to have a bunch of computers and a bunch of people answer phone calls and so on and so forth, and some buildings. You have to have that whether you're doing $10 billion or $100 billion in revenue. So it scales up nicely, credit card business. But even so, 25% is nice. But 25%, now, if you apply that to Square, that knocks the whole thing to pieces. So where has Square demonstrated they have superior operational efficiency to Discover or MasterCard or Visa? They haven't. So Square has 1/10 of those revenues, none of these profits, and yet they are priced, if I remember correctly, their market cap is $15 billion. They're practically priced as high as Discover already. So it doesn't make sense. If you like Square, you should love Discover. They're already there. They're already playing the game. People have Discover cards in their wallets and things like that. And that's the thing. And Square, there's no Square card. Of course, you don't need a Square card. You have a phone. But there's no Square card. They're looking to replace those cards. But then that's a lot of the revenue these guys generate is on the cards. If MasterCard only made money off the little transaction fees at the point-of-sale terminals, they wouldn't have those kind of margins, and neither would Visa or anybody else. Square's business plan is not to have cards. So why are you pricing them higher than a company that does have cards? It doesn't matter how much of that terminal business you take. It's not worth what the credit card business is worth. I mean, I don't understand why people, it's like people don't get these basic concepts. It's like, it doesn't matter how big they grow in transaction volume. It doesn't pay what MasterCard gets paid when they charge 18% interest to borrowers. Square doesn't have a borrower. Square is just charging vendors. That's all they do. And you use your credit card. Well, if Square comes out with credit cards, or something like a credit card, that would be different. But they would need massive financing to do something like that, and they'd have to raise a ton of cash. It would be a whole different company. There's a lot of these businesses that are disruptive, but they're disrupting people. They're disrupting the people who make money. Like, who was it? I forgot. There's somebody trying to disintermediate the middlemen in the pharmacy industry, which is great. I love that idea because they're all a bunch of bastards. Everyone's, taking money. And so they want to disintermediate the industry. So they want to make a direct connection between the drug companies and the end users, or at least through the doctors, go straight from the drug companies to the doctor to the consumer. Well, that's all well and good, because logically it does make sense. I mean, your doctor can prescribe you a pill, that's a Pfizer pill, and that could be somehow automated so that Pfizer gets a little tick mark and says, send you drugs. And Pfizer will then mail you drugs. That's it, no pharmacy. What do you need a pharmacy for? Your doctor told Pfizer to give you the drugs. I mean, this is how much they're giving you, this is how much they charge. All done. Should be no problem at all. If it's a high-scale drug, then the doctor would dispense it. You go to the doctor's office to pick it up. There's a lot of good ideas in that. But the thing is, a company like that makes money by disintermediating the middlemen who are there now, like the pharmacy and the distributors and the drug sales people. You get rid of all those people in theory, and then you keep some of their profits. But some of their profits is never going to be all of their profits. You're not creating, you're not making anyone's life easier. You're making more work on the doctor a little bit. You're making a relationship now. The pharmacy company has to not rely on their own salesman, but has to rely on a doctor to write a prescription. And how are they going to educate all those doctors individually without the sales force that they rely on? So there's a lot of things you have to deal with. But the point is, that company, even if it took over the whole industry, would never make anything like what the companies that are already there make. But people then value them because they don't know any better. They value them as if it's the same thing. You can't just being a disintermediary, being shaking the paradigms up. It doesn't mean you're going to make all the money the space is now generating. In fact, your model basically destroys that value. That those markups are being destroyed by your model. Amazon's got the same problem. Amazon's being priced as if it's going to replace retail at the margins that retailers make, but Amazon doesn't make the margins retailers make. That's why they're replacing them. They're willing to make no money. If you're willing to make no money and you're the lowest cost retailer, then yes, you'll get a large portion of the business, but you'll make no money. That's the catch. So how do you value them as if they're making the same money? It makes no sense. And you can say, well, I guess their business model is eventually they'll just screw everybody and start making money. But it doesn't work like that, because then other people will come in and fill that gap. So, a lot of stocks just get really mispriced, especially when they're not making money. They tend to get very mispriced because people price them against people who are making money, but they aren't necessarily in the same business. So that was a long answer to what I was talking about on Square. OPK, no, I don't care about that. TIVA, don't care. CTL. I noticed that TIVA's going up today. CTL's up. Not CTL. Who's the other ones up? TNC's having a nice day. Up 6%. So hopefully they found a bottom. We'll see what happens. So I talked about that a little bit because I noticed CNC was up. CTL. Albo asked, do you have any insight on trades? I said, look, in CTL, you have to be a super patient investor. If you're going to invest in phone companies like that, you've got to be a really patient investor. It's a year's trade. It's not a month's trade. So you're going to either decide that you're going to stay with them and accumulate shares and over time hope it does well, or and I had this one. I actually went and did charts and stuff for because I wanted to show, like, over time how you, if you stick with something, you can make a lot of money. But if you just worry about how it's doing that week, that month, that year, it's a terrible way to invest in them. So it's a question of your mindset as an investor, whether this is something you really intended to stick to make up, whether you really intend to make this part of your life for the near future. That you're a CTL investor and you're going to buy CTL on a regular basis, and if it's too cheap, you're going to buy more, and every once in a while if it gets expensive, you'll sell it. But it's got to become a lifestyle for you when you trade stocks like this, not just like, how am I doing this month? It doesn't make any sense to even look at it that way. And my example was GE. I'll tell you why. I can show you this pretty quick. GE, if you look at GE and you look at the chart, and this max, no, it's in max. Let's bring it out here. Yeah, okay. So here's GE before it took off. Okay, so here. This is 1962. This is basically when I was born, 63. So when I was born, and I mentioned GE, I said in my response, which is lost to the winds now, I talked about my grandfather, and this is, my advantage in being a trader is that my time frame as a trader is when I was this age, my grandfather would tell me about stocks, and GE was one of the stocks that he believed in. And my grandfather had been investing since the 1930s. And so he would tell me about a stock, and this went for all stocks. He would talk about stocks that he had in his portfolio, and the 10, 20, 30-year histories of those stocks, and why he bought them, and what they did, and how they went up and down, and so on and so forth. And he always saw everything as like a big tapestry of time. And so for my first day looking at stocks when I was a little kid, I thought of stocks as a long-term thing that you just watch over time, and that you don't expect them to either go up or down any particular day. You just want to buy a business that's a good business. It's going to grow over the years. That was the point of investing. I know it's completely old-fashioned and people don't even understand what I'm saying right now, but that was what stocks were. You would put money into a company, and that company would grow over time, and time being years, decades, and it would your investment would appreciate over that time as the company grew, and that was all. And there was no bullshit. You weren't watching it day to day, week to week. It didn't matter. You just want to see the company expanding. I know there was a company called Marks and Spencer's because my grandpa was in England. And there was a company called Marks and Spencer. They were clothing people, and he used to like them too. And they would build a new store. And that's investing in me. Like, he would own Marks and Spencer's, and he would go to where they're building a new store, and he would say, "Oh, I like this location," as if he actually owned the company. He always act, he was always like as if he actually owned the company. That's how he looked at them. And he would be like, "Oh, this is a good location. We should do good here, and this is the good traffic, and there's not too much competition." And then he'd go, and he'd go with me. We'd go on a bus. We'd go to the next town. We'd look at how that town was and what the competition was over there. That's how he liked to check out his investments. But and for me, because I saw him in the summertime, I would see him that year, and then a year later I would come back, and he's still talking about the same story. He'd be like, "Oh, they finally opened that Marks, that store they were building over here. They finally opened it, and it is doing well." And so for me, it's like, yeah, I'll check back on the investment next year. That was how I was taught to invest. And believe me, when I was in America, I didn't think twice about it the whole year. It didn't even cross my mind. But on the way, as usually would be, like on the way back, as I was heading back towards England and flying over there, I'd start thinking about what, like what I'm going to talk to my grandpa about. And I was thinking about, I wonder what happened to that store. I wonder what happened with this. I wonder what happened with that. But a year later, and I knew he hadn't sold it. That wasn't even a question. He wasn't going to sell something. He would buy something he believed in and hold it. Only if the company went off on a really bad direction or something very badly changed the industry would he change his mind. So here I am, like 10 years old, and my grandfather's telling me why he has GE. And GE at the time had been a good performer for him because he had bought more when it was down, and it went back up, and he was very pleased. But he sold some because he made a lot of money from when it was down. But he was holding on to half. So he had doubled down when it was down, and then it went up to double where it was, and he sold half. So he basically took all of his money off the table, his original money, and now he had a free ride on GE. He was very pleased with himself. Then when GE went down 2 years later, he did it again and accumulated more GE, and then it went up and up and up. Okay? Then he sold half. So now his half that he sold here was double what he started with, and he still had a ton of GE. Then it did this. Then it does that for the rest of his life. That's what happened. GE went up and up and up and up and up and up and up. So he always had some GE. It was always a big mainstay in his portfolio. Meanwhile, in the last, how did I do that? Weeks. There we go. So meanwhile, in the last 10 years, what is GE doing? It goes to 40. Then we have the big crash. Okay, fine. So the big crash and went to 10 or a little below 10. Then it went back to like 30-something. Now it's back to 20-something. All right? So, and again, by the way, one caveat, though. GE sold off a huge portion of their business in the last couple of years. They are not this company anymore. This company doesn't exist anymore. There's still a company called GE, but it's not the company that had GE Finance and all this shit. It's never going back here, not in the near future. But it's probably going back to the 20s. It should be around 25, and maybe, 30 I wouldn't even count it, but 25 is very fair for GE. And 25 is fine, because I'm not investing in it to be at 30. I'm investing in it to be around 25, and we're just going to collect our dividends and sell the stock and let it appreciate. And one day, hopefully, they'll hit the right combination and take off again. But right now, they've reconfigured the company so that their focus is very, very much on aerospace and aerospace, medicine, and aircraft, right. So I said that. Aircraft, energy, right. So it's energy, so think, GE is a 20-year forward-thinking company like IBM. GE looks 20 years in the future, and they say, well, the future is going to be demographically. This is something they can count on. They say, here's the world population. Here's what's happening. Okay, so aircraft, no-brainer. Boeing can tell you that. The air show we just had can tell you that. The countries we don't think about in Asia, the Chinese, the Indians, Africa, they are just now turning themselves into traveling airplane type countries. There's going to be so many more planes in the future. It's obviously an incredible industry to be in for growth. So GE wants to be in that. Medicine, obviously, aging population, that's an easy one. And what was the other thing? Energy. And energy, obviously, the growing population needs more energy. And energy for GE is new energy, like solar and geothermal and things like that they're heavily into. So GE has dumped everything else, and they focused on, they sold off all their other crap, and they said, this is what we're going to be doing for the next 20 years, these three things. And that's how they're mapping the future. Now, maybe they're wrong, but I think I see the logic in everything they're doing, and I want to own them for the next 20 years. And I don't know when. I don't know if it'll be this year, next year. You look at this chart. Well, what the hell? Where is that? All right. So you look at this chart. You own them here in 60s. They don't go anywhere. This is all under $1. This is down here is $1 or whatever it is, 85 cents, whatever the number is. So down here is $1, and up here is $1.20. So they're in this $1 to $1.20 range for the entire 60s and to the 70s. Then in the 70s, they have a little bit of a bright spot. Then they fail. Still that magical 120 line, right? Then all of a sudden, things start clicking. And they go up and up and up and up and up to 60. Now, I don't know when that's going to happen, but I like the company. I want to own it. I want to own it now. I want to own it 20 years from now. So I don't care day to day what they do. I don't look at my portfolio and judge the company as whether it's good or bad based on how they're doing today. So going back to the answer, I said all this by the way in the comment. I wrote all this stuff up, so it's much easier when I write things than if I explain it like this. But the point is, in the comment that I lost, I was saying that CTL is that kind of company. You've got to, and the same thing goes for Frontier, which we're into also, Frontier FTR. It's a long-term story, and they are, right now, they just spent a ton of money. They bought a bunch of lines. It's going to take them years to get on a steady revenue stream. They've got a ton of debt they're going to have to pay off on a 10, 15 years worth of debt that they'll be paying off. They are not going to zoom back up. But they think it's the future. And if you agree with them, then you stick with the stock. If you don't agree with them, don't even be in the stock. But if you think they're going to go back up to 10 tomorrow, that's not going to happen. And it's not going to happen next quarter, the quarter after that, or next year. There's a limit to what you can expect out of these stocks. But over time, if you want to hold them long term, they can be incredibly rewarding. But it's a different type of investing. You've got to have the mindset for it. So that was the answer to that question. And then we talked about, and then I had some notes for BBC on biodiesel. Chris is talking about green coin and currencies. Now, he is an evangelist of this stuff. He really likes these things. I am very skeptical. I treat it kind of like it's a joke, like Beanie Babies or something like that. But he makes good points. And believe me, if the government doesn't intervene, cryptocurrencies will take over the world. They do make sense. But then what's your government? If anonymous transactions of money are how we all start doing business, and your employer pays you anonymous money, and you go with anonymous money, and you don't need a bank, and you don't have to put your money anywhere because it's all in your little crypto wallet, and you don't have to worry about a bank doing anything with your money. You don't have to worry about anybody disclosing how much money you have or anything like that. It's untraceable, untrackable, and so on and so forth. What the hell is the government then? Then what is the purpose of the government? What are they going to do? So yeah, it's really nice that they have got this great idea that can topple all the governments of the world. They're not going to let it happen. Or, well, they might. They're pretty stupid. I mean, we've got, well, not all governments, but our government is pretty stupid. So I could see where it could slip through the Trump administration's eyes, and they could actually not notice that this is happening, and America suddenly falls apart because the financial system collapses. Not collapses, but the old financial system collapses and the crypto system rises, and there's nothing they can do about it because it's too late. That could happen. But otherwise, I expect smarter people like Putin is going to basically pull out a gun and aim it at Bitcoin people and say, no, not here. And so is China, because they're not stupid. There's no point to the government if they can't collect taxes and if they can't spend money and coin money. That's what a government does. They go to war, they collect taxes, they coin money. And then they build roads and bridges or whatever. But I mean, it's very, if you look at the budget of the government doing that, there's not much to it. And your local government can basically handle that. You don't need a national government. But of course, if you don't have a national government, that's a whole mess. But no, I mean, nobody really thinks it through. It's going to be a messy, weird system. Anyways, then we have some other questions, but webinar questions take precedence. So let's talk about that. And I really hope the people who I answered are on the webinar. Okay, so let's see. Oh yes, what are the indexes doing? Oh no, nothing exciting here. I don't see any good trades. Nothing here is exciting. Like I said, silver fell below 17, so now we're going to be looking for the 1690 area to pick some up. And I said last time I picked it up at 1688. I said if it goes to 1675, I'm really happy to get more. You've got to be willing to take that loss because it's a nasty moving thing. And the dollar, it happens with the dollar. The dollar's been very weak, so the dollar can easily bounce back and force gold and silver even lower. So I don't know what news is driving all this right now. We'll take a look at that in a minute and see if there's anything interesting. Well, I actually have a lot of things to talk about today. All right. Jal says, picked up the 2020 Guild 65 puts my comments. I don't really have any comment on that. I think it's a great price. I mean, Gilead, again, it goes back to it. It's like they've got a ton of drugs. They've got pipelines. They've got R&D. It's like they're a pharmaceutical company. You have to understand the businesses you're investing in. Like, if you invest in Ford, cars go in and out of fashion. And 1 year, Ford's got the hot car. 1 year, 1 year Chrysler has a hot car. 1 year GM has a hot car. It goes back and forth. And so some years they're up and some years they're down. Movie studios too. Some years they're up, some years they're down. TV stations, things like that. CBS, NBC, the ratings, some years they're the best ones, some years they're the worst ones. That's part of investing in companies like that. And pharmaceuticals are not much different. They have drugs, and some are hits and some are misses. They're always doing R&D. They're always acquiring other companies. They're always, using money for this and that. Sometimes they get it right. Sometimes they get it wrong. And when it's right, they get punished. Or when it's wrong, they get punished. When it's right, they get rewarded. Gilead's been basically nothing but punished for a long, long time. We bought them. I was banging the table probably from here in the 70s all the way down to here. We got this big pop, and that's great. And now it's back here in the 70s. I love it again. I love it just as much as I loved it when it was down here and all the way down. And when it's down, and by the way, if it goes all the way down here, all the way to 62, whatever that is, that's $63, I'm going to be banging the table on it again. And you'll say, oh, that son of a bitch told me it was good at 71. I think it's good at 71, but you know what I think is great is selling those 65 selling 65 puts of, where are we, of 2 million BC, 2020. 2020 sounds suspiciously like the future to me. I haven't had a problem with any of the other dates so far, but maybe it's just I hear 2020, I'm like, holy crap. That sounds like Star Trek. So look at this. The 65 puts you can sell for $8.30. So you're netting into the stock for, I don't know, 65 minus 9 would be 56. So it's like 56 and 70. So 56.70. You net into the stock for 56.70. That's like a third lower than it is now. And that's all you have to do. And by the way, when you sell these puts, this is an ordinary margin. This is it's not portfolio margin, this account. So let's see. You sell, and I want to get my 830, and I sell them. So if I sell 10 of these things, I collect $8,300. All right. Now, keep in mind, you are promising to buy $65,000 worth of Gilead. You are promising to do that. If they go bankrupt tomorrow, you're going to be on the hook for $65,000. There's your downside. But margin-wise, 56.66. So they give you $8,300 cash, and they take $56.66 in margin. That's a good transaction. And then I just wait 2 years, and if they're over 65 2 years from now, I keep the money. What is better than that? And all I'm doing is promising to buy Gilead if they get much cheaper. It's not a hard concept. There's nothing to explain about it. I mean, that's just a trade. But I love that one. 865 even better. Hi, do you think oil will continue down the next few days as contracts roll over? I do. I think there should be a decent amount of pressure on oil. As a rule of thumb, if they have more than 40,000 contracts a day to roll, they're in trouble. Because it's difficult. There's a limit to how much they can offload at each NYMEX session. And I don't know what counts as a holiday. That's the only trick to this thing. It's 3 trading days before the 25th. So certainly the 23rd is not a trading day. That's Thanksgiving. So here's 1 trading day, maybe. I'm not sure, what the deal is with Friday. But maybe 1 trading day, 2 trading days, 3 trading days. So Tuesday would be absolutely the expiration day. Maybe it's Monday. It's either Monday or Tuesday next week is the expiration day on the December contract. Either way, though, they've only got 1. So they got today, tomorrow, the next day, and Mondays. 4 days, maybe the 5th day. But either way, they've got way too many contracts to unload. They've got, as of this morning, I think it's down to 240,000 contracts. That's way, way, way too many contracts to unload. And why is this line ringing? That makes no sense. Damn it. All right, I can't talk this. I know it is. All right, anyway. Trader thought. All right, so that's with oil. So I just think at some point there should be a big amount of pressure where somebody's going to have to dump a lot of contracts, and we'll see a nice big spike down. But that'll be it. And then that'll be probably the best time to buy gasoline into the Thanksgiving holiday, because gasoline is likely to trade lower with oil. Oh, I know what I wanted to talk about earlier. This morning I was talking about how great the pivot points were working. You see on this sell-off, just like, see this day, hit this pivot point, and it came right back up. So today, hit this pivot point, and I said we should buy it here, came right back up. Because these are, and you can see here, this one hit this pivot point, came right back up. That's support 2, the second pivot point. The Russell broke below it, but the Russell we know is a crazy index. The Dow is a stupid index. But the MIC and the S&P and the NASDAQ, they've got thousands of stocks, so they tend to be a little bit more better behaved. They don't tend to go as crazy. Although, on the other hand, the NASDAQ can be affected by Apple. So the most reliable index is going to be the S&P, and you can see how it totally nailed that line. Now, it doesn't matter if these guys didn't hit a line, though. When this one hits a line, you can expect the others are going to do whatever the S&P does. So that was a clue, too, timing-wise. So can we see what time this is? Yeah, this is like 10:10, and this is probably 10:10 also, right? Yeah, 10:10, same thing basically. So everybody took off at 10:10 and did the same thing. So that's easy enough to call. You watch it, and now on the way down, you say, I wonder if it's going to bounce off this line. Then when you see evidence it's bouncing off this line, you play the line. That's all. Not hard. I see it coming back over this line. Therefore, you set that line for a stop, and you play it bullish and see what happens. You don't need me to tell you guys that stuff. That's how you play it. Why do you expect to pop on Tesla truck unveil? Because Tesla people are stupid. That's why. I mean, because he pops on any kind of bullshit that he unveils. He tells you remember, do you remember the demonstration where they showed the battery quick change, right? That they were going to have this mysterious, they showed the Tesla, they drove it in, and some machine came underneath the car and went, man, took the battery out and put a brand new battery in, and the car went on its way. And he's like, that's what we're doing now. Never happened. It was completely bullshit, set up, made up demonstration. Stock popped like crazy off of that. I said at the time, this is complete smoke and mirror bullshit. I said, think of the logistics of actually doing this. Where are you going to store the batteries? Who's going to watch them? What's going to happen to those batteries that you've got? How big will you have this gigantic underground complex that holds cars? Nobody needs car-sized batteries. That in theory, he was saying, we're going to take off this car-sized battery and give you a brand new car-sized battery, and then we're going to take the car-sized battery, and I guess theoretically they're going to recharge it, but that means they'd have to have a machine big enough to hold dozens of car-sized batteries and charge them, and then grab them and pick them up and put them in and clip them on, and if anything goes wrong, who's there? If anything goes wrong, you've completely disabled somebody's car. And you're not going to have a technician there? That's insane. And also, the cars aren't clean. They're coming off a road. They've got gunk on them, so the machine might malfunction at many, many levels, and you've got no one there to take care of it, or you're going to hire people to take care of it, in which case it becomes prohibitively expensive to man stations like that. There's a million. I mean, it was just a ridiculous demonstration that made no sense. Yet people are like, oh, he's such a genius. Whoa, it's so great. And then it never happens. Nobody holds him accountable to anything. It's an amazing thing. I've never seen anything like it in my life. I've seen many, many hucksters in my time of people who say they can do this and that and promise things that don't happen, but they usually get one shot and then they're drummed out. Then everybody walks away from them. This guy gets it doesn't matter how many chances he wants. They give him again and again and give him billions of dollars. It's incredible. So anyway, I just think that there's a cult of Tesla where whatever nonsense he promises about this magical truck that's going to hold. I mean, it's almost as ridiculous as a changing charger. There's physics involved. The weight of the batteries to the weight of the truck and the weight of the cargo added on top of that, you practically, now, if he was dragging a double truck, the thing where there's two trailers behind, and the back trailer was a battery, that might work. Okay, but you can't, in the space of a normal semi-truck, you can't possibly have enough batteries to have a really long-distance trip. And if you don't have a long-distance trip, then that means the truck has to stop for, whatever time, an hour to charge. Even if it's an hour to charge, it's going to stop for an hour to charge, at least. And plus, don't forget, you're talking about 10 times more batteries than the car would have. So it's probably not going to charge that fast. But even if you get over those hurdles, you've got a truck. The whole point of a truck is it's got to go from point A to point B in a certain amount of time. That time currently with human drivers in the system we currently have that works now is 20 hours, or from New York to Florida is 20 hours. From New York to California is 40 hours. Well, 40 I probably sleep sometime. Maybe 3 days to go from New York to California in the truck. They know the time, they know the shipping, they know this, they know that. If you can't match or beat that, then what's the point? You can say, oh, it's going to be a driverless truck, and there's going to be the magical battery change, and it's going to be fast, and blah, 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 and this and that. But meanwhile, we're so many years away from that kind of stuff being a reality. And there's no net advantage. The point of it is, and by the way, there isn't, especially because we have an administration that's not in any way, shape, or form encouraging conserving fuel. That's the other thing. If there was legislation in place that said that trucks need to drastically improve their performance and trucking companies will pay penalties for polluting and things like that, then I would be much more interested. But there's not. So given that there's not, given we have a president who thinks it's fine to just pollute all you want, doesn't matter, then all that matters is the lowest cost shipping solution, and this is not going to be it. So it's bullshit. That's what makes it bullshit. Down the road, hopefully, yeah, it'll work great, but it's just smoke and mirrors right now. Anyway, so I expect it to pop based on the fact that it always pops when he announces things, but not for a good reason. I want to short into it, but I think that ship is sailed. It's going to be very hard for me to short Tesla now, since my target for shorting them was 380, and now they're at 310. So how are they going to get back here? The truck is not going to get them back here. I guess if they get back to 340, the 50-day moving average, then I kind of would like to, I might want to take a poke at them here. Because they're not worth 340, they're not worth 300, they're not worth 250. Eventually, people will figure that out, but God knows when. It's the short who are short-term fearful. So what will drive the pop? I'm just saying it's just a matter of the fans who jump in on pretty much anything he said. Pivot points. How are they used? Okay, pivot points. We did talk about that. I promise we should say it. These are pivot points. And if you're on Thinkorswim, I mean, other systems have pivot points, I imagine. But on Thinkorswim, if you right-click on a chart and you go to Studies, and you say Add a Study, and then you go to Trend Studies, and then you go to P, then way down there is pivot points. So that's all you have to do. But there it is. Actually, if you take a picture of that screen, there it is. So Studies, Add a Study, Trend Studies, pivot points. And I use a standard. You can adjust these and customize them, but I think that's stupid because the whole point is I just want to see what everyone else is looking at because that's where you can expect those are now, what you have on a pivot point is you have the lines of support on the bottom and resistance on top. So this is support 1, support 2, resistance 1, resistance 2. And there's some mathematical formula, blah, blah, blah. I'm not a chart guy, so I could care less, frankly. But the point is, this is what chart people use to determine where they feel the motion of a stock is going to be in a given day. So anytime you can see a technical trading pattern like that, you say, ooh, this is probably where people will stop selling it because some computer program somewhere is going to kick in and start buying at this pivot point because things rarely go past the second support or the second resistance. Rarely. Not that they don't, because here's Russell doing it right here. But they don't, if it's not that often, they go more than one, what you call a standard deviation past it. So one more away would be the most. But that's not even something that usually happens. Usually things stay within these ranges. And so they're just useful from that perspective. They can give you some idea of where something will turn. And then from that, I'll calculate like the 5% rule to see if there's anything exciting happening there. Now, as you see here, support 1 on the S&P may be failing, which I would. Now, it's hard to tell exactly where it is. This thing doesn't tell you, but let's call it 25.55. So if 25.55 starts failing, and these guys, and he starts failing over here, and he starts failing, he's already failed over here, the Dow, then maybe we're going to leg down into the close. So that'll be interesting to watch. It's 2 o'clock now. So we'll see what happens. So that's it. That's pivot point. It's not complicated. It's just something that I find it very useful to watch, to get an idea of where something's likely to turn. 1020, my son wants to be your next pilot. Does he have a plane? Because I'm all for that. Let's see. SQYP. Oh, God, we talked about that. I don't really have thoughts on SQYP. It's just a silly biotech. I mean, we have money in it, but it's just because Farm Boy thought it was a good pick. I agree with the logic. See, they're recovering nicely already. Well, I mean, not that great, but look, SQYP they have a drug, it's been approved, it's going through the processes, it's only approved for one kind of use now, and they have to get it approved for like multiple kinds of uses so it can have a wider audience. But they did not find a marketing partner. So usually a small company like this will hook up with a big boy, and they'll have a that way the thing gets promoted through the existing sales channels and so on and so forth. SGYP has possibly insanely decided to promote their own drug independently. And to do that, they're raising $2 times 20 million. They're raising like $40 million. I don't know. I did the math this morning. What was it? Here. SGYP. What? Yes, it's right there. It's just a silly biotech. So while I was diving this morning, I said, this is about they have an equity offering. They're pricing 22 million shares at $258. So they're raising about $50 million, and they're raising it to promote their drug. They're raising it on a sales thing, on an advertising offering. They have to advertise and educate the doctors and get them to start prescribing their drug, and then they're hoping to get the other approval. If they get the other approval, it doubles their market percentage, and they're hoping they can do this themselves without a partner and reap all the benefits. But it's a daring move. It really is. Now, the offering is diluting the shareholders. They're selling, there's 200 million shares now, 250 or whatever. It's diluting the shareholders by about 10%. And the pricing was 258 up here when they said they're having the offering on Monday. Now, I think I said this right. Oh, yeah. I said it's possible they are being manipulated down by people who are trying to lock in a lower price in the offering. So in other words, if a guy wants to buy 2 million shares on Monday, but today he can dump 100,000 shares at a very low price and spike the stock down and hopefully panic people, and look at 100,000 shares, only a couple $100,000. So if a guy's looking to buy $5 million worth of shares, and he takes $100,000 worth of shares, and he dumps them to push the stock down, then he's got a chance of getting a much lower price on the 2 million shares he really wants to buy. And it doesn't hurt him. He just buys back the shares he's selling. Anybody can do that. It's very easy to manipulate the market like that, especially on a small stock like this. And that's what I think has been going on. I think after we get this offering out of the way, I think they might stabilize a bit higher. But anyway, and again, it's a long-term thing. Who cares what the price is today, tomorrow? They're either going to pull this off and make a fortune with their, by pushing their own drug, or it's a terrible idea and they're going to go bankrupt. So they probably won't go bankrupt though, because it is a working drug, and if they at this price, they can probably get bought out by one of the bigger boys. They just don't want it. They want to do it on their own and go it themselves. And it's a good plan. But it's dangerous. But again, they're disrupting. They're saying we don't need a big pharma partner to do this because the internet and everything makes it possible for us to get our message out and for us to have a web page and so on and so forth. I don't need a sales rep to knock on every doctor's door. I just need to send an email to every doctor saying, here's how this drug works. All right, it may be that easy, it may not be that easy. I don't work in pharmaceutical sales. My impression is it's a little bit more harder than that to just get people to start using something, but we'll see. Certainly it's worth a shot rather than give up half the revenues for their drug for the rest of their life. So we'll see what happens. Fibonacci or standard pivot points. I don't know. Those are standard as far as I know. Oh, no, they're certainly not Fibonacci. Fibonacci has a different look to it. Those are the choices on, so I guess if you're looking on E-Trade, it's probably standard pivot points. Fibonacci's good too, though. There's plenty of people who look at Fibonacci. I don't know that Thinkorswim has a preset Fibonacci. Let's see. That'd be interesting. I've never, or if they do, I might not like it. Studies, Add a study. Is it a trend study? Would that be a trend study? No, there's no Fibonacci there. The cycle study? No. All studies. Okay, let's try that. F. Fibonacci. There is nothing here that says Fibonacci. So I don't believe that they have a Fibonacci preset. So I do like Fibonacci's. I think they're fun. But my impression is they don't have that. They have incredible amounts of studies. I mean, it's really crazy stuff. And, to me, it's all, it's not the way I look at a stock. I look at a stock by what it's worth. I don't look at a stock by what it's charted. It's useful to do it. But like I said, the only thing I care about is the 5% rule. Oh, yeah, we're going to talk about that. Are we done with questions? You're speaking of aviation going forward. Can get a 4-year degree as a professional pilot. Pretty cool. Oh, yeah, sure. Yeah, I'm always up for a ride. I'll tell you that much. I love planes. Fib is on the drawings. Oh, it is. Okay, let's take a look. Oh, I guess it is. No. Oh, that's what I mean, though. It's not a study. That means it won't go with the chart. That's okay. So yeah, I can draw a Fibonacci study on a chart, but it won't follow like this one does. Like this is automatic. Once you set it, every morning I wake up, it changes itself. That's why I like it. I don't want to sit there and draw lines all the time. That's annoying. Yeah, okay. If I do Fibonacci's, I do it on stock charts. That's where I do Fibonacci's. Oh, look, I got my stock charts working. I'm so proud of myself. Remember we couldn't get it? So stock charts, if you click on a specific chart and you say you want to annotate it, this is, I guess you got to pay for it though. Here's my Fibonacci's. And then I can go like this. See, to make these nice lines. You guys have seen this, I've done these. And that's the Fibonacci line. So you just go from level to level and whatever. And then what I really like about stock chart though is after you draw it, you can still adjust it. You can still grab the little thingies and move it around, so you can decide where you want to, what you want to consider your top and bottom and whatever for the series. So I find that useful. Anywho, I'll do that now. But what we will do is take a look at, since we've now transitioned to a chart, we will look at the SPX, and we will look at what's going on here. So, first of all, on the big chart, and did we do a big chart today? I don't remember seeing one. Where is Jean-Luc? He's hanging out in France. He's not doing his job. No, he does it as a favor to us. It's really wonderful. But I will say, though, I mean, look, the 5% rule is just math. And Jean-Luc makes a chart for it, which is really nice because a lot of people like the visual. But the reality is, when I used to do the 5% rule until Jean-Luc came along, this was the 5% rule. I would have a chart with a spreadsheet, and I would have that, and every day I would say, here's what's red and here's what's green. So in other words, are we trending to the red or are we trending to the green? But we set these levels, which we actually reset in the recent past, so these are all good levels. We reset these levels, and then we do the math from it. And that's it. That's the 5% rule. That tells us where things are likely to have serious support and resistance. Now, visually, you can see how nicely that works. Look what happened with the Russell. 5% down, 5% up, 2.5% down. So if it breaks through here, we're going to see 1440 again. We see 1440 again, that'll turn red, and then we can start to expect to see some of these guys coming back a little bit. And I said today, the NYSE we've been watching, and right now the NYSE is where? Let me see. It's the NYSE is at 12,227, so it's below the 50-day moving average, the New York Stock Exchange. That's bad. And if it can't retake it by the end of the day, it's going to be a weakening sign. The Russell is well below here. So we have two big indexes below it. The two biggest indexes are below the 50-day moving averages. So that's a very strong indicator these guys are going to start rolling over. So, how do we know when something is rolling over or if it's just pulling back? That's what the 5% rule is for. And here's how it works. Oh, no, not there. Sorry. Actually, the better view might be here. So, oh, I know. I'm sorry. I wanted to, on the chart, but I did want to see something. So the S&P levels, you have the 15% level, and so if 10% was 2420, then that's 220 points above. So another 220 is 2640. So 2640 is the 20% line. So let's take a look at that. We never got to 2640. So we're not going to use that. Now let's see. So what would be in between it? Our baseline on the S&P is 2200. So 2200, and we're right about 2600. So 400 divided by 2200 is 18%. So I assume that we're pivoting on 17.5% line. So let's say 2200 times 1.175, 2585. So if we're following the 5% rule, 2585 should look like something significant on the chart. So, it's called the 5% rule, but every 2.5% matters. Every 1 point on a big index, it goes in, you cut it in half. So it's 2.5%, 1.25%, and even 0.6, whatever the heck percent. They all matter. But let's take a closer look. What do we say? 2585, and here's 2585. See how this line became significant? That's a 17.5% line. So, nobody knows this because this is our rule. This is something we follow that nobody else is aware of because it's something I came up with years ago. But the S&P knows it because it obeys the rule. It comes up to the 2585 line, fails, test, pulls back. 2585 fails again, pulls back, goes over, comes back, consolidates around it, goes over, comes back. When it fails at this time, it collapses, comes back, tests it, fails and collapses, comes back, fails, collapses, comes back, fails, big collapse. So I'd say 2585 is definitely the 17.5% line. And the funny thing is, and like I say, it's just math. We can predict these lines. When we first come up with the levels, when we have our support, coming up with support levels is complicated. But when we do come up with the proper support levels, the rest is easy because then we can tell you where all the pivot points are, and they don't change day to day. That's one thing I don't like about these pivot points. They change. They're always based on the day before's action, and there's some validity to that. But on the whole, I don't think it's a real pivot point. Should be the point where the stock pivots, where the thing pivots all the time. Not where we predicted it. Every day based on yesterday, I'm going to tell you where tomorrow is. Well, that's not that hard, but it doesn't tell me what's going to happen longer term. This tells me what's going to happen longer term. So, now I know for sure that the 17.5% line is in play. So we got rejected at 2585. What's the next line on the 15% line? So it was 2200, right? Times 1.15 is 2530. Oh, look at that. So the next line, the 15% line, is 2530. And now we know that between, wait, is that right? It seems like too little. It is 2200. Let me make sure about this. 2200 times 1.15 is 2530. Now, 2200 times 1.175 is 2585. Okay, that's much less than I would think, though. I guess it's so high above that it seems wrong. All right. So, you guys don't even know what I'm confused about. Basically, then, here's the range we're in now. From 2585, you ignore. Oh, by the way, very important part of the 5% rule is ignoring spikes. That's a spike. Okay, it went 2585 is obviously a proper line. Whoa. It was obviously a proper line, so we're going to ignore the spike over, and we're only going to count the drop from 2585 down. And the expected drop is from 2585 to 2530. All right, so can I draw something? I don't know if I can. I'm trying to think of how about, no, that's not going to help. All right, now let's try it back here. Okay, yeah, let's do, okay, good. Let's do that. All right, so now I'm going to do the annotation thing. So we're going to annotate, and we're going to get a line tool. Is this a line tool? I think it is. Horizontal line. There you go. All right. So let's call this the top. It's not really. I mean, it's the top at the moment. So 2585. Whoop, oh, there you go. And I guess if I highlight it, it tells me exactly where it is. How's that work? Why does it say 24? Oh, there it is. Oh, there it is. Oh, good. I nailed it. Okay, so it said 20. If you look over here, it just goes away. It says 25, 85, 98. Close enough. Okay, you can't really, it doesn't have fine adjustments. All right, so, bastard. Leap. You got to be careful to touch it. So 2585 is your 17.5% line, and wow, I feel the number now. Oh my God. 2200 times 1.15. 2530 is the 15% line. And that should be easy to find. That's going to be right here in the dead center of this. So there is your R. Okay, so that's the range we're now looking at. Okay, this is the projected range for the S&P as it consolidates. It's either going to consolidate for a move up or consolidate for a move down. Now, Mr. Calculator, please. How do we then use the 5% rule? Well, 85 minus 30 is 55. Okay, so 55 points is the range. So from a retrace perspective, what we're going to expect to see on a retrace is we're going to expect to see 20% of the move is a weak retracement. All right, so 20% of the move is weak. And 55, so it's going to be 11 points below 25.85. So 25.85 minus 11 is 25.74. That's a weak retracement. And a strong retracement is going to be double that. It's going to be 40% of the move up is going to be a strong retracement. So that's minus another 11 is 25.63. So if we're obeying the 5% rule, 25.63 should be the support of a strong retrace, which is basically right there. Now let's see if we can draw that line and make it thin, kind of, I don't know. Well, should we go with blue? I don't know. Well, give me these choices. So what do we say, 25.63? 63.59, 63. Damn it. That's 65. It's very hard with the little thing here. 63.73. Close enough. Okay. So now, hang on, let me make it bigger. Control plus, plus, plus. Okay. So now you can see how this actually worked. So in the dead center, this would be the weaker retracement. But in other words, so what happened is we came up, we hit resistance at the retracement line, broke over it, tested here. I would bet that if you map this, that you're going to find that's an 11-point move up. We probably overshot by the same 11 points. 20% overshoot is very normal. And then you come back down 20% under here, and then that failed and 40% under. And now this, if this doesn't hold, though, you're going to be very likely to be seeing a full retrace all the way back down. Okay, obviously you're going to hit some support at the 50-day moving average. So you'd be looking for the next stop would be here, like 45, and then below that you're going to come all the way down to this line here. If that line fails, though, then you're in big trouble because now you're retracing. Then you have to back out and look at the much bigger move and say, well, where were we? What was before that? So in other words, well, then we're back to the big chart because then you can look at the big chart and say, okay, well, now if we're failing this, 25.30, so if we're failing the 15% line, now you're going to be looking all the way down here to the 12.5% line. And you can see how you had consolidation there and a breakout, and it flew up. But we never had a retrace from the 15% line. So we don't have we're not very established up here at all. We went up and up and up without a retrace. So technically, it's not surprising we're having a strong retrace here because this run from 12.5 to 17.5 is really the uninterrupted run that hasn't had a pullback yet. So in that case, you'd want to look at the number here, which is, I'm just eyeballing now. So say 24.75 to 25.85 is 475, so it's 110 points. And then, well, yeah, obviously it's 110 points. And then therefore it's a 22 point. So a weak retracement of the bigger run is 22 points, the same 22 points that the strong retracement of the smaller run. So you see how it all falls into play, it all lines up, and it all works out perfectly. That's what's so great about the 5% rule. Because if you said what's something likely to happen, that's what's likely to happen. So then what does that mean? That means the next fall, since we're very likely on this bigger patch here, that means the next move is likely to be 22 points down from here, and that's going to take it all the way back to so this 25.60 line. So basically, this is I can almost tell you that we're going to hit 25.60. This is going to fail. What's happening today is going to wait. Where are we now? Yeah, we're at 65. Well, it did fail. We did hit 25.60 today. Without that chart wasn't updated. So we did hit 25.60 today. We hit that because you're looking at a strong retrace of this. Now, we hit this line and we tested it. But now the question is, are we really bouncing off that? And then you've got to take the line from 85 to 60, which is 25 points. And now you have to see if you're having a strong bounce, 20% of the drop, or weak bounce, 20% of the drop, or a strong bounce. So it's either going to be 65 or 70. And we're currently at 65. So this is what you call a weak bounce. And we topped out at 70. So we hit the strong bounce. Now we're at a weak bounce. If we finish today below the weak bounce, we're almost certainly going below 25.60 tomorrow. So that's what you can watch right now to see what's going on. So I hope that was clear. So let's see if we have any questions on that. But that's the 5% rule, but it's just math. That's all it is. It's easier when I can have time to draw it out and do examples like I usually do in chat. It's hard to do it on the fly. But the concept is simple. It's just really you do the math between the levels, and then you do then the rule is 20% bounces, 20% retraces, and then you have to look at the period becomes important. You have to figure out which period is dominant. The dominant period here is this 5%. This 5% move up from 12.5 to 17.5. That's the move that is now pulling back. All right, and I think we're going to definitely see a test of the 50-day moving average. I think the NYSE will not get back over. The Russell is going to stay under, and therefore it's going to start pulling everyone back to their 50s, which means you can make good money shorting the Dow or shorting the NASDAQ right now. Especially if Apple keels over, then that'll be nasty for the NASDAQ. Oh, nobody had a question. Fantastic. There's an aviation degree from Wisconsin. Well, it's true. If you're going to spend a lot of money in college, you're better off buying them a plane. I mean, that's what matters is the time you spend in the air. I got a pilot's license back, how old was I? I must have been about 30. And In fact, I used to be scared of flying. Funny thing, I used to hate going in planes. When I was in my 20s, I hated going in planes. And I was traveling a lot for work. And I was so miserable every time I got on a plane. So I decided the best thing to do was to learn how to fly one. So I figured if I know how to, because it's a control thing, I think, partially. So if I learned how to fly one, I wouldn't be as worried about it, which turned out to be true. It worked for me, I'll tell you that. So I took flying lessons. I got my pilot's license. But I thought I was going to buy a plane. But then I found out, when I got my solo license, there's all these rules, which is sensible rules, because it's how Kennedy died, actually. If there's bad weather, you shouldn't fly by yourself. If there's this, if it's cloudy, if it's this and that. So constantly, my solo flights were getting canceled. The whole summer, I think 6 weeks in a row I was supposed to fly. I couldn't fly because the weather changed. And it was, because I can only fly after work, and it was a bad time of day. But, if you fly in the middle of the day, it's easier. But I wanted to fly after work, so every time it was a bad time because the weather changed. So 6 weeks in a row got canceled. And I'm like, well, this isn't going to help. It's like my concept of getting a plane was I could fly up to Killington in Vermont, which is a 4-hour drive, and I could make the flight in like an hour and a half. So I could cut down my time for skiing. I have a condo up there. So I figured that'd be worth it, to have a little plane, go up there myself and skip all the traffic and zoom up and zoom back, and plus I could do other short flights. So I had good reasons to want a plane at the time. But between that and Kennedy dying, I actually met him right before he died. His wife was a girl I was dating, was one of her very good friends, and she died too, unfortunately. So I met them at some point right before they got married. And then, not before they got married, so before they died. And that really put me off of flying, too. So between that and the weather thing, I was like, this is all bullshit. I'm not going to do this anymore. Let professional people do it. But I sleep like a baby on a plane now, because I know that, a person who has that kind of experience flying is perfectly capable of dealing with whatever happens. So I have no fear of planes whatsoever. Even turbulence, anything, I can care less. I'm like, well, they know what they're doing. Don't worry about it. Obviously you can be unlucky just as you can be unlucky in a car, but generally it's very safe, and these things are very well built and work fine. So anyway, 1020. So the point being that I don't know whether it's not worth an aviation degree, but I can tell you that it certainly would be more worth having a plane, because it's all about how many hours you fly. There's nothing more important than flying hours, and flying hours are prohibitively expensive if you're flying somebody else's plane. If you have your own plane, you get your license, then you start flying other people, for a job as a taxi service. As long as they pay your fuel costs and you're flying around for free, you get your hours, and that's what it's all about. And as you get your hours, you can move up to bigger planes and do all kinds of stuff. So it's good stuff, and there's Uber for planes now, so you can get involved in that. Actually, turn it into a little business. Can't fly for love without a 4-year degree. Oh, interesting. You can't compete. Yeah, but I think flying for love sucks. I'm under the impression that's not a good job. I think you want to be a private pilot for somebody. You want to be in a private fleet, or you want to get into the air taxi service, to get into, even start your own company, but do one of these companies where you ferry people around for realistic prices. Because I work with a helicopter company in New York, and they do fantastic business. It finally occurred to the guy that it's difficult to get one guy to pay $10,000 for a helicopter, for not $10,000, $2,000-$3,000 to go to the Hamptons. But when 6 people pay $200 each or $300 each to go to the Hamptons, that's easy. You can easily get people to do that. So it's the same price for him. He's just putting people in a helicopter, but he either flies with empty seats or it doesn't. So instead of having to look for one rich guy and be on his schedule, he tells 6 people what time he's gonna leave and what time he's gonna come back, and they're like, okay, because for $300 or $400, I'll arrange my schedule around that. So that's a great business. And if you can do that, but then the point's got to be, you've got to be focused on, I need to be able to fly this kind of plane. I need to be able to have 6 passengers or 8 passengers. and I need to be able to fly like this. And if you have to have a goal to get to the point where you can run a profitable business. But look, pilots have been making money, flying people for years. It's just, but the way the internet is now, and Uber and all that stuff, is you can easily work out operations where you arrange to fly people places for money, and especially you're in San Diego, I think, right? So it's from San Diego to Vegas and things like that. You'll always have people who are willing to pay to do those flights. And yeah, it's definitely fun for a young guy. So that's the kind of thing. That would be my goal, not to work for Southwest and get like minimum wage. I don't think that's the way to go. I think you want to get, have your own little company and do it, and eventually that can lead to bigger things. Being instructor, that's another way to go, being instructor. But yeah, flying was fun. I liked it. I really enjoyed flying. It was a good thing to do. What else are we going to talk about? Oh yeah. So remind me if I missed a topic. So we talked about that, and now let's talk about a few stocks that we liked. So we'll go over to, on our virtual portfolio tab, we have the watch list update. And let's see. Here's our March watch list from this year. Here's what it was, and I'll show you what these stocks look like. We had Target. Don't forget March is the beginning of these charts. So here's March. So we had Target. We had Aflac, completely rocking it up. BMY zoomed up. Delta has been erratic, but it's up from where we started, and amazingly, I picked the airline before Buffett did. ESRX has been disappointing. Not all these, So ESRX has been disappointing, but we still like it for the long term. Freeport it was down here when we liked it, because I always like them when they're on sale. They're kind of cheap again. I still like them. Freddie Mac. Oh, wait. That's not the same kind of chart. Freddie Mac, I like the 250. I think they're a bit higher than 250 now. That's not. This is not a dynamic chart. GCI, they took off. This is Gannett, the papers. GE, horrible, but we're still, in fact, my whole of the new thing, the whole top, we're talking about GE. Gilead, as we discussed, it was way up, and now it's back down to where I actually kind of like it again. H&R Block. Oh, love them down here. I just think I called a new play for H&R Block. Also took off nicely, and now pulled back a bit, but still a good stock long term. Janus Capital got bought, so they were way too cheap. They got bought out. LB, I totally love these guys, and they're still cheap. When they were down here, you guys know that. I think how much I remember I talked about LB in the last few months. Now they're coming back to still a reasonable price at $50, but just not as incredibly ridiculous as they were at $35. Macy's is now very cheap, and I love Macy's going forward. PBI Pitney Bowes, they got wiped out. So I don't know if I still like them. I forgot. If I still like them, they'd be on the new list. I don't know what I decided. PSA is public storage, and they've been erratic and down. But my point was, when we did it, though, this is one of the ones where I said, we talked before about selling puts. This is my attitude here. I don't like a 226 stock, but this one pays a nice dividend. So at 220, I'm interested. And I said, but if we sell the 200 put, sell the September 210 puts for $9. So September, and it ended up being, it was way up here. So the 210 puts expired worthless, and you collected the $9. So from March to September, which is only 6 months, you collected $9, and the dividend's $8. So instead of getting $4, you get $9 for not owning the stock. Never forget, that's a great way to play a dividend stock, is just sell the puts. Why go through the whole rigmarole of buying the stock and hedging the stock and this and that, when really all you have to do is sell the puts and you collect the money? That's all you really want was the money, right? QCon was so good they got bought, or potentially getting bought, whatever the deal is. C is also they're kind of noodling along, but I still like them. Sunoco was way too cheap. They flew up from where we liked them. Super Value is still cheap, or cheaper, in fact. And again, they're part of the whole supermarket Armageddon thing. And we have a play on them. We like them still. Taser went way up, way back down, way up, and way back down. How can you not buy them when they're down? It's the same thing. It's like the other thing we were talking about before. It's like it's in the obvious channel. When it's at the bottom of the channel, you buy it. When it's at the top of the channel, you sell it. It's not complicated. So this is, well, moving away today. We have a big day today, but moving away. But this is the time to be buying them. Target also kind of in a channel. They had a nice dip. They came down. They're back here. They're down here. We added a boatload here where they're down, and now they're up here and coming back down a bit. But on the whole, we have a 50-60 spread. So we own the 50 calls in next January. So we're way out here, and we sold the 60s. So this is our limit up here. So we don't think it's going higher than this. And it's pulled back to 55. As long as it makes a little channel here, I'm perfectly happy with it. In fact, it's great because we get to sell all the calls along the way. Verizon got cheap again. There's no date on that one. Verizon got cheap again, so I like them here. Whole Foods got bought, another one too cheap. And Exxon, what a freaking ride that had. I was banging the table on Exxon below 80. Now they're back over 80. I mean, 80 is the right price for them. If when they get lower, they're good. When they're above, when they get too far above, they're not good. Because it's just such a gigantic company that you can't expect them to do much. 81.50, that was where I liked them. So they're back to 81.50 now. But again, see what I said? You can sell in 2019, 80 puts for 9. That puts you at $71. Buy the 70-85 bull call spread. That's the way you play these things. Look how conservative. My 70s are way down here. The 85s are up here. We didn't expect them to go higher than 85. And we got a year until it goes that way. It's not hard to make money on these things. You take nice conservative entries and you sell a lot of premium. So there's that. Mostly winners, pretty much. I'd say 3/4 of winners on that one. I talked about the GE position in great detail. And remember, this is under the virtual portfolio tab right there. So anybody's a member, and if you're here, you're a member. Should be able to see it. So let's see. All right. So what I talked about here in GE, the most important part of it is I don't care if it's up or down or sideways today. I care about the fact that I'm working on a plan, and my plan is in June, we spent $54,000 on 2,000 shares of GE. Then we sold premium against it. We sold calls, we sold puts, we sold even more calls. We collected $14,000. So we only laid out $40,000 total to GE. It's not about whether the stock goes up or down. It's about if I can keep collecting that $14,000 even every year, 3 more times in 3 years, or not 3, I'm sorry, this is for 18 months. So every 18 months, if I collect $14,000, that means in 3 sets of 18 months, which is 4.5 years, I will have gotten back all the money I laid out for the stock. And I've got free stock. And that money, of course, gets put to work on other stuff along the way, just money, available funds in your portfolio. So what happened since then? Then we sold these calls for $7.50. We sold these calls for $7.50. We collected dividend. And there's a number here somewhere. I don't know, whatever the number is. Oh, our net basis is now $34,390. So we started at $54,000. And since then, we've collected $20,000 in not even 6 months. . So So it's going to be actually a lot less because I'm selling all these calls in between. It's going to be a lot less than 4.5 years before we're fully paid off. Probably 3 years, we will have recouped all the money we laid out in GE, and we're still going to have the 2,000 shares of GE. And that goes back to what we talked about before. It's a long-range plan. It's a long-term view of the stock. I don't care in between times if GE, if it goes to 10, I'll care a bit. I'll probably double down if it goes to 10. But if it's at 15, if it's at 20, if it's 25, what's the difference? I only care if I'm collecting my money. As long as I'm getting all my money back from what I laid out for the stock, and at the end I have 2,000 shares of GE, whatever they're worth is my profit. So if they're worth 10, my profit is $20,000. If it's worth 20, my profit is $40,000. And I can keep going and keep collecting all these. I can keep renting it out by selling puts and calls and collecting this money, or I can just collect the dividends and sit back and relax. And I've got this asset that I never have to worry about, never have to touch. That's the goal of this kind of investing. So every quarter or every month or every day staring at the stock and worrying whether it's going up or down is pointless. That's not what we're buying these stocks for, especially big dividend payers. It's got nothing to do with why we're in the stock. All right, so that being said, with that in mind, I like Chimera Investments. They're a REIT that I definitely like. It was $17.87 on the week. Oh, it went up and now went back down, but whatever. It's around $18. So we have a play for that. ETE, Energy Transfer. Again, they're in a channel. They're low in the channel, so I like them. When they're up in the channel, I'm not going to like them as much. And here I've even been cautious. I would just sell the 2020 $15 puts for $260. If I sell the $15 puts for $260, my net is $12.40. Then I'll buy it. If it actually drops to $12.40, and I don't think it's a total disaster, then we get assigned the stock, and then I'll buy it, and then I'll start selling puts and calls like I am on GE. But meanwhile, I'm perfectly happy just getting paid $260 to not own it. Ford, it's still 1201. It's funny, it doesn't move. So 4 to 12, I like them, and again, that one is another one wonderful to play. GCI, whoa. What? Has this happened since the weekend? All right, anyway, so they had a big pop. 1018, yeah, they were 1018. They were 1018 when I wrote this up. That's funny. So GCI we've been in since May. We've been in GCI since way down here. They're way up here now. I still like them though, because again, you just get paid so much money on it, and I go through all the logic here, so I'm going to go through it again. You just make so much money selling puts and calls that you're going to get this money back. It says we're down to $15,920 on God knows what. What are they? We started out. No. I'm talking about 2 years. We can expect 2 dividends. Okay, so in 6 months. Oh yeah, okay, I'm sorry. So on this trade where you're buying $20,000 worth of the stock, 2,000 shares, you get down to $15,920 in 6 months. So you're collecting a quarter of your money back in 6 months. That means in 2 years of doing this, 2 years, you have free stock. So do I care if it's a 10 or 9 or 8 or 11 or whatever? No. As long as I'm going to keep collecting my $5,000 every 6 months by selling puts and calls, and as long as they're expiring somewhere in the range where I can deal with them, then I don't care because the stock's free. And if it's at 6 when it's free, I have $12,000 for free. If it's at 12 when it's free, I have $24,000 when it's free. But free is free. My goal is to have a big portfolio of free stocks. And I'll keep collecting, especially free dividend-paying stocks. So I'm going to keep collecting dividends, and this is 64 cents. But I've got no cash in it. And what am I doing with that cash when I collect it back? I'm buying the next dividend-paying stock and the next one. And eventually, 20 years from now, I've gone through 4 cycles like that. So if I start out with $250,000 and I run through 4 cycles where I collect back all the money and put it back to work, now I've got $1 million worth of stocks in 20 years. And that's a very conservative time frame, by the way. $1 million worth of stocks in 20 years. Plus, I got my $250,000 back. Now they're paying me whatever the hell the dividend is on $1 million worth of stocks. So if I'm taking stocks that pay 5%, I'm getting $50,000 a year just for doing nothing, which is 20% of my original $250,000. And then I do it again for 20 more years, and I have $4 million worth of stocks paying me $200,000 a year dividend. So in 40 years, and I'm being super conservative with these numbers, in 40 years, if I start with $250,000 today, and that's my salary, and say I want to have my salary when I retire, if I follow this plan with $250,000, I'll be collecting $250,000 in 40 years. And no, it doesn't get eaten up by inflation because the dividends rise and the stocks appreciate over time with the inflation. So it'll generally pay me what will become my salary today. So if I want to make my salary of $250,000 for the rest of my life when I retire, I'm a little closer to retirement than that, but if I'm a guy in my 20s or 30s and I want to have that money when I retire, all I have to do is take a year's salary, put it aside, run this program for 40 years, and you will have, and again, my numbers are very conservative, you'll have a lot more than that really, but you will have, in the very least, you'll get your own salary paid to you, adjusted for inflation, every year for the rest of your life, and even when you die, it'll go to your children and so on and so forth. Not only that, though, don't forget, I'm getting paid this on the $250,000 example. I'm getting paid that with $4 million worth of stock sitting in the bank too. That's just the dividends they're paying off. I could have also kept selling options and selling calls and selling some more puts and playing games, but I'm just saying conservatively, simply doing it. The easiest way in the world to get rich and retire. But people aren't willing to put in the time and don't have the patience to do it. Because they always think you've got to make money right now, otherwise it's no good. But the reality is over time making the money is the most powerful way to do it. Gilead, we just talked about. H&R Block, I think I mentioned that I still like them down here. LB, definitely still like them. Macy's, I like them so much they're blue, so that means I like to trade right now on those guys. They have nice pop today, okay. NLY is the same management team as CIM. I like them also, another very good REIT to invest in for the long term. And again, might go up, might go down, doesn't matter. It's a good, strong team. And whatever the conditions are that cause it to go down, they will probably be able to figure it out and get over it. And let's do NLY. So, you got to be realistic. It's not, there's nothing magical about these things. Look what happened to them. They went way up, they went way down, they go up, they go down, now they're going down. There's different cycles in the economy. But these guys know how to manage their properties through thick and thin, and they'll keep it in this range, anywhere from 750 to 1750, basically, even 20. Because sometimes the rates will be in their favor, sometimes the rates won't be in their favor, sometimes the real estate market will go up, sometimes it will go down. I don't care as long as they keep the company going and keep investing in new things, and eventually they'll hit a good cycle. That's what cyclical companies do. But what I do know about them is they like to pay a dividend. They like to pay a very fat dividend, more than 10%. They went through the financial crisis without being destroyed. Where is that? 2008. So here, they went through the financial crisis. They managed their way through that. Now they're in a down cycle again, and they're managing their way through that. So I like being invested in a company like that when it's not too expensive. That's my favorite kind of company to be in. And whether or not they pull it together, we don't care because we're selling these options. But we care that they survive. We don't want them to go bankrupt. That means we can't sell options anymore. As long as they're functioning and we can keep selling options, we know we're going to get our money back. And if they keep paying a 10% dividend, I'm going to be very happy with them. Oh, here's PSA. So I just called for selling another put. It went down. You sell one put, we'll sell another put. What's the big deal? Oh, SKT. I love these guys. Tangiers. They mostly have open air malls, but not bullshitty ones, like really nicely done open air malls. They make it like a little community, and they're very good with their stuff. They make them kind of classy, and the best thing about them, I like what they do is they hold these events. They always make it like they try to have event spaces, so they'll have like a little every festival, every possible holiday. They'll always have something going on to attract people. For Halloween, they get all their vendors to do trick-or-treating stuff so the kids run around the place. So, and on the weekends, people like to hang out there because it's like nice, and they're very good at mixing. Very important, by the way. It has to be experiencing. You know, when you go to these malls, people don't really go just to shop, but they also don't like to go just to eat. So, but when you combine the eating and shopping and spread the places through, and you have different places to get little snacks and get it, you know, there's always on this end there's this, on this end there's that. There's a little food court. They do everything that you want to do to have a place where kids can hang out and parents can hang out and people are happy to meet up for lunch and things like that. It's what keeps them going. So they're very good mall managers, basically. So I like them. And again, it's a REIT. They pay a dividend. They're beaten up. I like the price. So this is a good one. I really like these guys. Target just took a bath today. They're down 8.4%. But I like them. They also have a nice dividend, which they're not cutting. And I think they're going to work out their turnaround. We have here we talked about selling, buying the stock, selling. We only sold the $60 calls. We didn't have a high target. We sold the $60 calls, and we sold 5 of the $55 puts. So that's 2020. So our net here, we started out with $30,000. We collected $8,000 back, and I said in 25 months we'll have recovered $10,000, blah, blah, blah. So we're 33, in 25 months, in 2 years, we get 33% of our money back. And so that means that in 6 years, we get all of our money back. And then it's free. So again, if it's at 40 and it's free, and I got 500 shares for $20,000, it was free. I already got 1/3 of the money back. I'm going to get the rest of the money back over the next 4 years. That's fine. I hope it isn't 40. I hope it's 80. But meanwhile, if it's 40, it's not going to kill us. If it's 80, we're going to be thrilled. Oh, and I said and then we're collecting some more money. We spent two of the January 65s. I even said it looks toppy at 62.50. Where did we fall from? Right here, 62 something. So it's basically doing exactly what we thought it was going to do. There's no question about that. And that's it. And I said I was going to work on some more, but I forgot it was. I'll get to it eventually. I'll add some more. It's portfolio week, for the expirations of Friday, so I have to do all the portfolios before I do anything else. And that's it. What time is it? Oh my God, look at the time. I gotta go. How are we doing? Many seasoned pilots retire with love, flexibility, and good wages. Okay, I'm just figuring they're a typical airline, but maybe they're better. Year 10, I left $200,000. Oh, sign me up. All right. I guess I should have put in some more hours. That's not bad for a pilot. It's not such a hard job. I mean, it's a responsibility, but I wouldn't mind that. All right. A little late. A little late to change careers. All right, anyway. Okay, well, nobody else seems to be buying talking. All right, guys, so that's where we are, and that's where it stands. There's nothing, unfortunately, exciting to trade at the moment, but I really encourage you to, and let's talk about it next week as well. I really encourage you guys to read through this thing. So I went into great detail on the GE thing, and I went into good detail on all the ones we're talking about as far as what our actual trading plan is. So I think that's part of the problem is maybe I don't articulate the long-term trading plan. Because every time I can't go over it again and again. Look how exhausting this is. So I can't every time we have a play talk about like all the different, what we expect to happen over time. But think about these things in terms of building portfolios and building your wealth over time. And it really is an easier way to play things. Instead of worrying constantly about the market and whether it's up or down or taking advantage of this or that, it's nice to have at least a portion of your portfolio that's just building some steady wealth. Despite yourself, basically. It's going to just keep growing and building wealth for you. And before you know it, you'll be very surprised. 3-5 years from now, you'll look back and say, holy crap, this is actually working. And that's what happens in, Phil Stockwell with our long-term members. A lot of them have what we say is a light bulb moment. All of a sudden, it's like it clicks. And they go, holy crap, because they realize, like, after doing this for a few years, they go, wow, this is really working. Because, the first time you do it, you're just sort of creating this artificial discount on a stock. But then when it actually works and you sell the next set of puts and calls and you just drop another $10,000 in the bank on something that you bought, 2 years ago that you even forgot about, that's fantastic. That feels great when you're doing that. And that's when you suddenly see your portfolio go, wow, all of a sudden it starts really moving up fast. And that's what happened in the long-term portfolio too. It struggled the first year, but that's because everything was new the first year. And when you have new stuff, it goes up, it goes down, blah, blah, blah. But once you get to this point where we have a 3-year-old long-term portfolio and the stocks are mature and we're just rolling money in, it's just a money machine. And the butterfly portfolio too, which is also old, it's a money machine. It's just constantly collecting more and more money. It almost doesn't matter what the market's doing. You're just constantly collecting cash and collecting dividends. And that's the best way to build a portfolio. But it's the hardest way to start because it's so abstract at the beginning, and if it's not the way you've been trading, it's so hard to learn. It's so hard to break all those bad habits that people tend to have. But I really advise just reading through this thing and thinking about it, and maybe using going through these two portfolios. They go back to years, and you can look at the, you can keep going back to 2013, whatever, and look at when we actually started the new portfolios, and see the stuff that we added and what we did and why we did it at the time. Here's a top trade review. Here's this from like 2015. A stock of the year we talk about here. In fact, here's here's a great one to audit. All right, I'm going to go after this. What is this? How to make $100,000 in 12 months trading stocks, options, and futures. Wow. What is this? Let's say we put $10,000 cash into each trade. Oh, no, I'm sorry. We already made $100,000. So there's 11 trade ideas. Oh, well, you know what? It did make that much money. How do you know? So here I was talking about Apple being our trade of the year for 2015, and that trade will take 2 years to resolve with the 2013 trade of the year, blah, 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 blah. Did I actually put out the trade? Oh, well. But even here, you can see, in fact, look at it. Here's NLY, $9.94. This is the $11 stock we're just talking about, right? It hasn't gone anywhere. Of course, it's not going to go anywhere because it pays out 90% of its profits back to the investors. It's not going to go up much. But the point is, look at what we make on the son of a bitch. And all the time. We had Taser, we had DDD at the time, we had Alcoa, that was a good buy. Alcoa split since then. Apple, of course, obviously is a great one. Oil futures, oil short at 103. Oh my God, that made $110,000. Two shorts made $110,000. That's funny. We have Intel. Obviously, Intel made money. Ford made money. Apple again made money. Leico, wow, forgot about them. What are they? Are they even around anymore? No, they got bought. That's the problem being a value investor, is because stocks that you like get bought. ISRG, oh my God, they're like huge now. ISRG, what are they at? 390. So what do? We sold the 290 puts. See, it's a simple trade. We sold it, it was at whatever. We sold the 290 puts for 31. Our net entry is 260. And we just keep the money. Oh my God. Oh no, we sold Tesla call. I wonder how that worked out. That probably didn't work out so good in the end. But, so anyway, so it's good to go back and look at those things, because you can see what I said at the time and what I was thinking at the time. And it's definitely worth it, because if you're not, I think if you intend to be a long-term investor, there's a lot of stuff in these articles here and also in the education section, which is right there, that you can go back to and reference. But the point is, it's like a little time machine. Like, you can go back and say, oh, here's what he said then, when he, and then you look forward and say, now you have the benefit of hindsight. You say, oh, okay, that's how that worked out in the end. And that can hopefully give you like an idea of like, this is what we're saying now. And these are the trades we like now, just like we like those trades then. And 2 years from now, you'll say, oh, and then I'll write another article 2 years from now saying, oh, look how these trades made $100,000. And you'll say, oh, why didn't I know about this? This is them. This is how they work. But they don't work fast. You just have to let them run their course. What levels would you propose when you trade in G? I would go with GE now. It's perfectly good right now. I think I wrote that up. It's written up in the thing. I mean, it's cheaper today than it was when I wrote it, but yeah, there's my GE trade. Oh, no, that's not my GE. Sorry, that's not my current GE trade. Do I have a current GE trade? Well, hear that. I mean, yeah. Meanwhile, it's only been blah, 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 blah. We'll do that the whole place. All right, you know what? It's not clearly articulated as a new trade. So, as a new trade on GE, they don't pay as good of a dividend now. Only 2.5%, so a little not as good as it was. But still, it's 18.20 now. See here, it's 18.20. You can buy the stock for 18.20. You can sell the 2020 $20 calls for, let's say, $2.20, just to make the math easy. That nets you in for $16. You can then sell the $15 puts for $1.30. All right, so now you've gotten back, what we say, 220 and 130 is 350. So you've gotten 350 back on your 18. That means that your net is $15. Your entry is like around 15. And if you get the stock put to you again, you'll have 2 times at 15. So let's say you buy 1,000 for $18,000. You get collecting 350 back. So you're basically buying 1,000 for net $15,000. Okay, and you may end up getting 2,000. If it's below 15, you'll have these assigned to you. You'll have 2,000 shares at 15. Now, the dividend now is probably like 50 cents. So you'll also collect $1,000 in dividends. So by the time you get to 2020 in January, you will have gotten paid $1,000, and you'll be down to 14,000 that you're into this stock for. Your call away is at 20. So if you do get called away, you're going to get called away with a $6,000 total profit on the trade. All right, which is fine. I mean, that's 40% or something like that in 2 years. This is what you expect on a dividend-paying stock. But meanwhile, 40% in 2 years is great. Or if you don't get called away, you're going to knock another 350. You're going to go through the same cycle in 2022. You'll knock another 350 off the price, which is $3,500, and your net will drop from 14,000 to, let's say, 10,000-ish, right? Then you're going to collect another 1,000 in 2 years, and now your net's down to $9,000 into 2022. And then 2 more cycles like that, and your stock is free. That's all it takes. But in the meantime, it takes patience because we're talking about something that will take, in this case with GE, it'll take you 8 years before you have free stock. But that's free. That's what you want to work towards. You want to have a whole portfolio full of free stocks that you've got all your money back and put it back to work and bought more stock, and then you take that money and put it back to work and buy more stock. And if you just do that as a habit, that habit can make you very, very rich. And honestly, it's like it's a real shame if you don't at least take a part of your portfolio and do that, and not just gamble on everything in short-term trading. Something should be building wealth, and the wealth, and I'm sure most of you guys are parents. So I don't want to get too preachy, but as a parent, I think it's just so important to be able to leave something to your kids, not just money, because this is different than money, because this is well-invested money. And if I leave my kids a portfolio full of all these dividend-paying stocks that generate a nice income and put it into a trust or something like that, that just pays out for their whole lives, then I take care of them forever, basically. And that's a good thing. That just allows them to get through their lives without the hassle and without having, and it's not like some money's going to diminish. I mean, it'll be there, and maybe they'll be greedy. Hopefully, they teach them not to be greedy. That's the point. But if they do that, and if they allow that to grow, then they'll be able to leave it to their kids too. So you're talking about building generational wealth, and having something that's really of value that generates a real income that they can count on forever. And that's why I like building up these portfolios of dividend-paying stocks. It's really something of value that you can pretty much, obviously you never know what's going to happen in 50 years, but, you assume that it's going to be, especially with companies like GE, that are just going to, they'll adapt with the times, they'll change. And I like having stocks like that. I like having a solid portfolio like that. All right, anyway, time to go. And thanks to everybody for coming. We will do it again next week. All right, take care, folks.